crashes have long been a part of financial markets that in turn have caused investors to respond fearfully. Since the turn of century, markets have seen many downtrends followed by uptrends, with the 2008 to 2009 housing market crash resulting in more than 663,000 people losing their jobs in March 2009. Watch the video till the end as we tell you about the market warnings and reasons for people to sell and what holds for financial markets in the coming future. It all began with the Federal National Mortgage Association increasing house loan availability in 1999 for borrowers with bad credit histories along with little extra cash for down payments. These so-called subprime borrowers were provided with mortgages with terms of repayment that reflected their high-risk profiles, such as high interest rates and variable payment schedules. Moreover, previously ineligible borrowers and investors were drawn to the greater availability of mortgage loans, which sparked a meteoric rise in mortgage originations and property sales. Consumers, many of whom were now newly purchased homeowners, took on more debt at the same time to purchase other things. Not only this, the companies who wanted to take advantage of the opportunities provided by the booming economy excessively leveraged themselves as well. Similar to individuals, financial institutions increased the returns on their investments by using affordable loans. Consequently, the stock market that was being driven by debt began to exhibit signals of imminent collapse as the investment bank Bear Stearns was unable to cover its losses related to subprime mortgages in March 2007. However, even though things were bad, the stock market didn't crash and continued to rise, reaching 14,164 points on October 9, 2007. Nonetheless, the inevitable was soon realized as in September 2008, the major stock indices had lost approximately 20% of their value. Then on March 6, 2009, the Dow reached one of its lowest positions, 54% below its peak. This was followed by S&P 500, the Nasdaq 100, and the Russell 2000 all experiencing crashes and recoveries within a 36-minute window on May 6, 2010. This was known as the 2010 flash crash and resulted in the DJIA losing about $1 trillion in market capitalization. Even though it recovered almost 70% of its value in the same trading day, it instilled great fear in the overall market, and many experts suggested people to sell their assets to save themselves for further losses. Quite interestingly, in September 2010, the CFTC and SEC came to the conclusion that the flash crash was caused by the convergence of a number of factors, including a significant amount of E-mini S&P 500 futures trading, illegal manipulative trading of many E-minis, and electronic liquidity providers pulling back on quotes once stocks started to fall. This major manipulation resulted in the US and international stock markets declining as investor confidence was depressed by the failing US economy and the escalating European debt crisis. Furthermore, before this incident on August 8, 2011, the US had its credit rating downgraded for the first time ever by S&P because of a prior deadlock over the debt ceiling. Even though the political impasse was eventually broken, S&P believed that the accord fell short of what was required to restore the country's finances. This downfall was followed by a slow recovery, which was evident from the fact that in March 2013, Dow Jones Index only had 5 positive days in a month since 1968. After seeing a recovery, the markets fell off again in 2015 and 2016 as a result of a series of stock market sell-offs that started in June 2015 and lasted for a full year. This sell-off resulted in Dow Jones seeing one of its worst days ever as the DJIA lost 1,000 points for the first time ever in August 2015. As a result of a number of turbulent economic situations, such as the conclusion of quantitative easing in the US, a decline in oil prices, the Greek debt crisis, and the Brexit vote, investors sold shares globally, which led to the start of the market's turbulence. More than 2 years later, in 2018, the world of cryptocurrencies saw the infamous Bitcoin crash, often termed as the Great Crypto Crash, with the majority of cryptocurrencies being sold in fear while experiencing large value losses. In total, the value of Bitcoin decreased by over 65% between January and February 2018. This decline saw a very slow rise, and as it was nearing its recovery, the financial markets again saw one of the most major stock market declines in recent history. This crash was a result of the COVID-19 pandemic that saw all countries imposing lockdowns everywhere. Consequently, during the week of February 24, the Dow Jones and S&P 500 experienced the steepest weekly declines since the 2008 financial crisis. The reductions were 11% and 12%, respectively. The Dow Index then had its biggest single-day loss since Black Monday of 1987, when it fell by 9.99% on March 12, 2020. On March 16, the Dow saw an even greater loss of 12.9%. On March 16, the stock price decline was so abrupt and severe that many trade halts occurred on the same day. The DJIA lost 37% of its value between February 12 and March 23, and NYSE trading was periodically halted. Although the COVID-19 pandemic's impact on the market was one of the worst in recent memory, it also led to one of the swiftest recoveries. After the stock market recovered, the S&P 500 reached record highs on August 18 and the DJIA reached 30,000 for the first time ever on November 24, 2020. This speedy recovery was fueled with the Federal Reserve cutting interest rates and pumping $1.5 trillion into money markets, as well as Congress adopting a $2.2 trillion rescue package. But by this time, many investors and long-term holders had already sold, resulting in huge losses. As a result of this speedy recovery and huge losses, many experts suggested that in case of market crashes, long-term investors should resist the urge to sell their investments, as the length of the stock market rebound is extremely difficult to forecast. After the raging bull market of 2021, which saw cryptocurrencies and stock markets generate astronomical gains for everyone, 2022 has been marked by red for stock market investors. Most of the months in 2022 have seen consumer price index data continuously revealing that inflation is rising. Numerous individual firms and almost all major indices have had double-digit losses, which has many people wary of investing more money in the already failing stock market. According to a survey dated May 2022, 56% of American investors felt the stock market's volatility had prevented them on purpose from making any investments. As inflation isn't going down and markets are still falling, investors may be even less willing to invest their money in the markets. So, if you're thinking about investing or wish to start your trading journey, you need to remember that the bottom may not be in just yet. In light of this, numerous studies and past data have demonstrated that timing the market is very difficult. In other words, the ideal strategy isn't always to wait for the market to decline and in fact invest your money in tried and true investments and give it time to work for you. Furthermore, try dollar-cost averaging your way into the market to keep your average spending low and your expectations high for strong returns. Not only this, if you want to avoid depending on the performance of a single company, think about investing in index funds that follow the performance of the entire stock market or the S&P 500. On that note, we will end today's video. We hope you enjoyed the content of the video. If you did, show some love and hit that like button, and don't forget to subscribe to our channel so that you never miss out on any of the amazing videos we have in store for you.
Don't forget to check out our other videos. Want to learn about stock shorting? Or maybe you want to get started with crypto trading? We have you covered. If there's any finance topic we haven't covered yet that you want to learn more about, give us a comment and we will get right on it. Until next time.